Good morning. Who's alive? Ni hao ma. Jumbo. Yeah. Yeah. All right, let's get on with it. How you doing? Welcome to my office. Guten Morgen. Welcome to Trade Non-Farm Payrolls Live 187. Felt like playing maybe like some Snoop Dogg instrumental, but that would be Red Flight. 187 on the... Yeah, there's so many great West Coast 90s gangster rap that would mention the old 187. Murder was a case they gave me. Dear God, I wonder if you can save me. You guys remember that? They're pumping on my chest and I'm screaming. I stopped breathing, damn, I seen demons. Dear God, I wonder if you can save me. I can't die, my boo-boo's about to have my baby. You guys remember that? Anyways, 187, man. Yeah, and if you don't know, that's the call sign that the police force uses for a murder. We got a 187. Yeah, anyway. So, hey, welcome everybody. Glad you're alive. I'm glad you're here. I'm glad you're a Forex trader. Very, very cool. My name is Wayne McDonell. I'll be your host today. I'm the Chief FX Market Strategist for Traders Way. I'd like to thank FXStreet for hosting this webinar now for 187 months, which if you're adding up, is somewhere between 15 and 16 years of doing just this one webinar. I've been a speaker at FXStreet for probably 18 years, which is pretty amazing because that's probably more time sharing my sort of outlook to the foreign exchange market than your last guru has even been alive. So anyways, 18 years. Then he found out it wasn't his. Anyways, 18 years, baby, on the 187. So that's cool. So thank you for being here. And I'd like to thank the moderator for being the best moderators I've ever seen. The industry of moderators look up to our moderator. And they're like, that is how you moderate. So thank you for being here. We got this thing called Non-Farm Payrolls. It's actually two different reports. So we will kind of talk about that. We can see about the information reported on FXStreet. And the history of that is I wrote an article many years ago on how to model and trade the employment situation report. And that later got turned into an FXStreet sort of methodology for preparing Forex traders for the report. So we'll go after that. However, let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So, this is about interaction and participation. I'd like you to participate and ask questions. I will do my best to address the questions. Now, bear in mind, there's more than a few people in the live stream, and so you might ask a question. It'll take you 10 seconds to ask it, I might give you a 10-minute response. Meanwhile, 100 other questions have been asked, and I'm not looking at the chat. I'm actually answering that question. So you might have to repeat the question a few times. Don't spam the chat, but I'll do my best. I'll be here for, a couple hours to answer your questions, which is pretty cool, I think. Now, like I said, I'm the Chief FX Market Strategist for TradersWay.com. TradersWay.com is a boutique foreign exchange trading firm. And we would like to be your execution partner. Now, you might say as a trader, hey, man, I want low fees, man. Well, look, the spreads are competitive, but if you would rather have an ECN, you can have an ECN account. Okay? Now, your ultra cheap broker is probably lying to you and slipping you half a pip in, half a pip out. You can't even see it, but you're probably paying more than you think if you went for ultra cheap. What you want is competitive. You don't want to overpay, but you don't also want ultra cheap. There's no value in that. The second thing is you want fast execution speed. Okay, Traders Way. I tested many years ago on their execution speed relative to like 25 other brokers. The biggest brokers you can think of are the slowest because they have so many people on one server that they're actually quite slow, which is not ideal. Right? But Traders Way is quite fast. Not the fastest, but almost the fastest, right? So that's enough. It's enough, right? It's got low latency. Nice. Okay? But I'll tell you what, and I've done this often, even just recently, you can compare the spread, the swaps on Traders Way to whatever broker you might be using right now. And most of the time, you will find that Traders Way pays you more on swap. And many brokers, even big ones. I just tested one, a big brokerage firm out of London. And I checked out the swaps they're paying, and they're double charging you on. I think I only found one they were actually paying you a swap, but every other currency they were, whether you were long or short, they were charging you on the swap, which means, like on South African Rand, they should be paying you the equivalent of, whatever they're paying. Let's say, 5 or 6%, right? And instead of paying you 5%, they were charging you 5%. So it's a double dip. Instead of you earning, you're paying, which means the differential is like 10%. You're like, oh my God, this huge London broker is screwing all their clients. Oh my God. So anyways, be careful, man. So if you visit tradersway.com, open up a demo account, maybe they can earn your loyalty and respect. That's all. Try them out, man. Maybe they'll earn your loyalty and respect. Because ultimately, when you choose a broker, it's all about trust. So, all right. So let's get into this. We got NFP. What do you think the number's going to be? 5? What do you think? 5? 5K? 500K? 5M? Yeah, probably around 500. So we're on trend. Now, you may have heard in the media that we had a good non-farm payroll, we had a good ADP, so NFP should be good. Well, be careful. Be cautious about that logic. Now, since the Fed has been a market participant in the bond market, their goal is to increase employment and thereby consumption, right? So they're manipulating the bond market. Now they're manipulating it less in November than they did in October, but nonetheless, it's an artificially inflated bond market, which keeps interest rates relatively low. And by interest rates, I include yield. Okay. And, it's by design to rebound the economy. And we went through all that back in 2008 as well, where the Fed had to step in and save us all because the government didn't do anything. Okay. Oh, well, there was cash for clunkers. But besides cash for clunkers, the government didn't do anything effective. So it was all about the Fed and Ben Bernanke. Great. So since then, if you look at the activity of the central bank to save the economy, well, think of like it's doing something. It's influencing something. It's creating a correlation. It's a manipulated market. Now, we all want it to be manipulated, but it's not supply and demand, right? The Fed is stepping in to create demand. So you have artificially high demand, but that's what the central bank's about to do. It's good. It's not a bad thing. But what I'm saying is because of that, it's created a correlation. And you can go all the way back to 2008. You're like, that's a long time. Okay. But we're moving towards less and less influenced by the Fed, right? That's what the taper is. And then eventually we'll normalize interest rates. But nonetheless, less and less QE, right? So the point I'm getting to is when I studied the correlation between ADP results and non-farm payrolls results back before 2008, okay? So my quant, Kurt Worley, you guys probably remember Kurt Worley. He's done, I would guess 50, right? 50 webinars at FXstreet over the years. When he was my quant, I said, hey, Kurt, can you look at this? Because I hear in the media that they say, hey, ADP was good, so NFP is going to be good. Can you actually look into that and see if it's true? So he went back decades comparing the two, or as far as he could, and then came back and he said, you know what? It was interesting. There was no positive correlation, which means if ADP was good, non-farm payroll should be good. There was no negative correlation, which means if ADP is good, NFP would be bad, or if ADP is bad, NFP would be good. Because if there was an inverse correlation or a negative correlation, then you could actually trade it. You say, well, ADP was good, so I'm going to sell off, NFP. But that wasn't the case either. What he found was comparing ADP results with NFP results over a long period of time, there was actually no correlation at all. So now that there is correlation, yet my opinion is that's because the market's manipulated and forced small and medium-sized businesses use ADP, right? See, when you're a company of maybe 100 people, you have to decide, should you have a department that handles your payrolls and your benefits administration and so on and so forth? You're basically an HR department, right? Do you need to hire a bunch of people to do your HR for you? And you're like, well, that's kind of a cost, right? It's an expense. Well, it's a cost, right? Now, if you hire ADP, what happens is they'll do it all for you. And you're like, wow, that's better than hiring 3 people at $100,000 each, right? So you hire ADP. So it's for small and medium-sized businesses that have employees, but not so much that they need their own HR department, right? Now, the bigger companies wouldn't be included in that. Your companies with, hundreds or thousands or tens of thousands of employees, well, dude, they got their own HR department, right? And they're certainly doing all this internally, right? Cool. So ADP represents the small and medium-sized businesses. Well, with the Fed and the government stepping in, well, that's going to influence how they hire. And then, of course, big businesses, once again, they have low interest rates, they have low yields, so they can go to the bond market and raise capital, and it's cost effective, and that's all good, right? But when you start removing all of that, then you'll see there a dichotomy should be created where small, medium, and large and ultra large, multinational corporations, there would be a difference between them. They wouldn't be all the same, right? And therefore, if small businesses are having trouble hiring, well, why is that? Well, the employees looking for work are only getting hired by the multinational big companies, right? So you're like a little company in the Silicon Valley trying to hire people, and yet everybody wants to work at Apple and Facebook and Google, right? And you can't get, and those 3 companies are stealing all the best employees, and now you're struggling, right? And that would be normal. Okay, that would be normal. And so I'd caution this idea. Now, it might actually be true right now that there is a high correlation. Just just food for thought. On the long run, in a normal market, that's not actually the case. So you got to be careful. Right? Yeah. Cool. Productivity decreased 5% in the non-farm business sector in the third quarter of 2021. Interesting. I wonder why that is, eh? All right. So anyways, let's take a look here. According to FXStreet, the numbers are, drum roll please, 4.25. More than double last month. Hey, that's a good guess, Victor. Yeah, and there's more coming. Okay, we got to be careful because the strikes, and of course, Biden's going to solve our problem with the ports. My concern as an economist and even as a capitalist is that the Biden administration's solution to all of this is unionization. I'm like, okay. So we'll see. Yeah, worker dissatisfaction. Okay. All right. Average hourly. Okay, we want to look at this. Why do we want to look at this? Well, in the last week or so, let me get my drawing tool. By the way, it's really cool hanging out with you guys. Thanks for being here today. Would you, just as a courtesy, would you click the thumbs up button so that FXStreet can hit the YouTube algorithm? Remember, this is not for me. It's for them. Just as a common courtesy, say, hey, thank you, FXStreet. This is cool. Okay, all right. I got my drawing tool here. So I have, in the last, I don't know, a week, done research for the RBA, right? Reserve Bank of New Zealand, Bank of Canada, the Federal Reserve, Bank of England. Okay. And the ECB. Okay. Now, if you were going to synthesize all of this into a commonality, a common theme of what they're trying to tell us, I would synthesize it this way. Okay. Inflation is high. Okay. 2, they believe it's transitory. And 3, they believe it's transitory, meaning it will naturally, right? It will naturally solve itself, the supply and demand. So if you pay too much, you're incentivizing those in the supply chain to produce more, be more productive, and all that kind of stuff, right? Okay. So they believe it will come and go on its own over time. Maybe it's 1 year, maybe it's 2 years, but whatever. The high inflation will go away. And they believe that as long as wage inflation is low. So speaking about low at the RBA, Governor Lowe said in Australia, inflation is plus 3%. Headline inflation. Wage inflation is only plus 1%. And he said multiple times, they're not even thinking about raising interest rates until wage inflation starts with a 3, not with a 1. And essentially, Australia, New Zealand, Canada, the United States, England, and Europe said similar things. That as long as we don't have wage growth even remotely close to headline inflation, then the headline inflation is transitory. That in economic terms, what you want to talk about is sticky inflation. Now, examples of sticky inflation is if your salary goes up, it's very unlikely for your salary to be reduced. It just doesn't work that way, right? Once your boss comes in and says, hey man, you're doing a great job, I want to give you a raise. Or you get a promotion and now you make more money than you used to. Either way, it's very rare where they come in and they're like, hey, we negotiated that salary for 120. Yeah, we got to kick that down to 100, right? You're like, whoa, you can't reduce my salary. So salaries are sticky. So if there's inflation at the wage level, wage growth, that's likely to stay forever until there's a recession. Okay? And then that might reset. So if we don't have wage inflation, then it's transitory. Another thing that happens, and you can look at this in PCE and CPI and stuff, but things like rent. Okay? Your rent typically doesn't go down. If you agree to pay $1,000 a month, next year it's probably $1,050. The year after that, it's $1,100 a month. And the cool thing about that type of real estate is it's $1,000 a month, and in 5 years, you probably negotiate some sort of increase. But the cool thing about that sort of retail apartment building is that you have high turnover, right? Because people they come in, they rent, and then they leave. And the turnover is so quick that you can just then raise rents there. So rents at that level turn over really quickly, and so therefore it's always tied to the economy. So if the economy falls into recession, people move out of your apartment building because they can't afford it anymore because they lost their jobs. And when you replace people, you can just replace them with lower rents. So your rents are always matched to market conditions, right? Now, commercial real estate like a warehouse, you sign a 10 or 20 year lease and you might be giving it away cheap because you negotiate rent this year, but 10 years from now rents have doubled and you're still locked in with your client at the low rent level and you can't do anything because you got a 10 or 20 year lease. So anyway, so it's a different type of risk. So rents typically don't, like long commercial rents, retail rents, like how much AT&T pays for their retail store, those tend to be very sticky. And then of course wages tend to be sticky. So some types of inflation just really don't come down. They go up, then they go stable, and then they go up again. And so all these central banks have said, dude, we're not interested in raising interest rates at all until we see that this inflation is not transitory, and we'll see it primarily through wage growth. Yeah, you'll see it in PCE and CPI because that includes rents, right? But really what they're looking for is wage growth. And if there isn't significant wage growth to match the inflation, then the inflation itself is artificially high because of supply side constrictions. And that will naturally solve over 6 months, a year, 18 months, 2 years. Nobody knows. But over a period of time, it will normalize because supply and demand always meet in equilibrium. And then that inflation will come back down, probably closer to the wage growth number. So let's say wages do go up to 2% over the next 2 years. Well, over the next 2 years, transitory inflation, like supply chain issues, will probably come down to 2%, right? So wage growth might go up to 2%, the 3% comes down to 2%, and somehow we get closer to a proper equilibrium, right? So here's the other thing that I've noticed in my research. Like, I think the Fed said it. I think the RBA said it, right? And there might have been one more. where it came to interest rates. Oh, well, Bank of England, right? Yeah, okay. Bank of England was widely expected, widely reported that they were going to raise interest rates, right? You guys remember that? Just like, what was it, yesterday? Everybody said the Bank of England was going to raise interest rates, right? Now, if you do your research, you know what? You know what they said about it, the Bank of England? When they were asked why they didn't raise interest rates? You know what they said? We never even thought about it. We weren't even talking about it. He said, in fact, I said in multiple speeches, it's probably not going to happen. So then the reporter pushed back. He's like, but you communicated that you might do it. So we priced all the traders priced it in. And he's like, no, I didn't. He said, no, I didn't. So RBA, for example, Governor Lowe literally said that interest rate hikes are priced in. You can see it, and I can show you how it's done, by the way. I can show you what's being priced in the United States. Okay, that's not government work. That's actually the market pricing in interest rates. I can show you how to calculate it, right? So anyways, the RBA, Governor Lowe, said that he notes that interest rates are priced in with Australian government bonds. He's like, I see it. Interest rates are there, priced in, like we're going to raise. You know what he said? We're not going to raise interest rates this year. We're not going to raise interest rates next year, and we probably won't raise interest rates the year after. And yet, we come together as a market, as participants, and we're debating how many hikes to, like, why isn't it a debate? Why can't you just listen to Lowe? Isn't that interesting? Fact over market discussion and debate. Why the market discussion and debate? Why are you pricing it in when the people that actually do it say they're not going to do it? And therefore you get disappointments like that pound crashing. Some of that on the retail side we're selling, right? You're picking up some pips and that's all good. But what's really happening? Big, powerful, institutional idiots were betting that the Bank of England was going to raise interest rates because they saw something on TV or they read something in a newspaper and they're like, you know what, let's make a big bet. Let's just bet all our money. Bank of England's going to raise interest rates. But then if you actually did the research yourself, they're like, no, we're not. No. And then they're like, we didn't signal to the market. That was somebody else. They basically blamed Bloomberg. It was funny because Bloomberg asked the question and he's like, no, it's you guys. He's like, I didn't say I was going to raise interest rates. You said I said that I was going to raise interest rates, but we didn't even talk about it as a committee. Isn't that interesting? So anyways, I hope one of the big message that I'm sharing with you today is that fundamentals do matter. And that you should be doing this type of research. You should actually love doing this type of research. Okay? This is part of the job. Okay? And this could set up your bias where you can say, I think New Zealand will raise interest rates far sooner than the RBA. And then you say, well, Wayne, why do you have that opinion? And I'm like, oh, well, they told me. Okay? They told me. It's not my opinion. That's what they told me. Isn't that cool? New Zealand's major concern is housing. Okay? Mortgage demand is high. The banks are flush with cash and they're making loans. Big businesses in New Zealand are doing well. The unemployment rate is 3.4%. That is so good. It's amazing. But farmers and small businesses are still struggling because they don't have the debt service requirements to be able to access the funds from banks. Also, there's issues with the supply chain. So the farmers might be producing, the dairy ranchers might be producing, but they're having trouble getting it to market. And maybe China's not buying, or if China is placing orders, you can't get a boat to ship your cheese or whatever. And so there's some issues, but they believe that is transitory. You see the level of specifics? Okay. Jimmy says fundamentals don't work anymore in an irrational market. Oh my God. It's irrational? It's interesting. I don't believe that. So I'm not here to say you're wrong and I'm right. I don't believe that. And what you're saying is you don't believe my point of view, and that's fair, Jimmy. Okay. Yeah. So Forex Pipper says, yeah, central banks don't want to raise interest rates because of it's hard to service, right? That's the debt service ratio, right? Of course, the United States doesn't have a problem with that because when the global economy is doing bad, interest rates go low. The Fed and the government, right, rack up debt, if you want to look at it that way, rack up debt, but when debt is cheap. So the U.S. government loads the boat on debt when interest rates are incredibly low and even free for a while, right? So they're borrowing super cheap money at a time when the dollar is also strong. Now, fast forward in 5 years as they're servicing this debt, the economy is rebounded, taxes are up, right, which is income for the government. But the U.S. dollar is weak, and now they're paying back the cheap loans they took with cheap money that was created in the process, you see? So that's good if you're a reserve currency. It's bad if you're not a reserve currency, right? And so central banks have different concerns and needs and stuff. But right now, what you might be seeing in some situations, we could look here, in some situations, like this is the last few days out of South Africa, for example, you can see despite the dollar being strong, which I was just showing you, let me go back to that. Okay, here we go. So recently the dollar's been strong, right? So then we go back to this. If the dollar's strong, let's go back to South Africa. Well, then why is South African rand strong? If the dollar's strong, why the heck is this coming down? You're telling me the dollar's strong, but South Africa is stronger? Why is that? And what has the trend been? Dollar strength, 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 dollar strength. You hit the Fed meeting, and as of the Fed meeting, dollar is still strong, but rand is even stronger. Whoa! What did the Fed say? By the way, that was my prediction for the trade plan. But anyway, so what did the Fed say that made the dollar strong, but the rand even stronger? They said they're not raising interest rates anytime soon. And people had already priced that in. Okay? Now they're saying, oh, well, they'll raise interest rates maybe later is what people are thinking, just not sooner, just, I guess, more later. Okay? And the result of that is an emerging market that has a lot of U.S. debt will benefit if the dollar weakens and effective yield and interest rates don't go up. So they get an extra, let's say, year of breathing room before their debt, their variable debt changes. If they have variable debt tied in dollars, then that variable debt is not going to get more expensive for a while. It's a bit of a reprieve, if you will, and that's good news. But here, people were pricing in that the U.S. would raise interest rates soon. Okay? Yes, that is right, Jimmy. And in fact, right? The RBNZ talked about that a lot. Okay? They talked about that a lot. It's a real concern of the central bank. Okay? It's fine. Simon said, didn't Lagarde say at the beginning of next year inflation would decrease? Yes. AKA transitory. Yeah. 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 So that's part of it. All these major central banks have said something similar. Okay. Okay. All right. Cool. So interesting, right? Interesting. And look at something similar happened with Mexico too. Okay. The peso's weakening, or you could say the dollar's strengthening. And one logical reason for that is people thought interest rates, right, in the U.S. would go up next year. And then now market participants listened to the Fed on Wednesday and found out, oh my God, that might not be the case. Boom. Holy smokes. Okay. Wiped out 2 days worth of upward price action in just a matter of a couple of hours. And now the thought process for you guys would be, what's next? Well, you might put this across, okay, and think about something like this. Okay? If it does, then you do. Okay? All right. Appreciate the enthusiasm, Jimmy, but slow down, buddy. Slow down. Whoa. Take a breather, man. All right. So anyways, that's sort of the thought process with Mexico. Now, think about it. If the U.S. is doing okay, let's say the U.S. is okay. It's doing okay. Not bad, not good. It's doing okay. And over time, right, the U.S. will do better. So you don't think next year will be worse. You don't think there'll be, another variant next year. You don't think there's another shutdown. You think China will improve its COVID situation. Like, all you're thinking is, we're doing okay now, and next year will be a little bit better. Then will that benefit Mexico? You would think so, right? Especially with supply chain issues with Asia, more and more businesses might move some of their supply chain to Mexico because it's right across the border. And Mexico and the U.S. do a lot of business together, and that might actually improve. Now, if U.S. businesses are going to shift some of their supply chain to Mexico, what happens? The United States is exporting dollars to the interbanking system, exchanging it for pesos to pay their Mexican supply chain. If that happens, peso goes up, US dollar goes down, and you see this. So when I draw something like this, what I'm saying is, you're thinking the US is doing okay based on the economic data that we have now, and your belief for the near future, aka next year, is that it'll be a little better. Not dramatically better, maybe dramatically better, but you're not really saying that either. You're just like, hey, everything's okay, and next year will be better than the last. And with supply chain issues with Asia, we'll probably do more business. Even if we did the same amount of business, maybe we'll do more. And that would benefit Mexican peso. And it's at 20 something now, and in 10 years, it'll be at 10. Yeah. There's a big move built into this macro. So if you believe just sort of this message here, that might be good. Now, on the other side, you might have Canada. And the same thing would likely happen. The U.S. is facing some supply chain issues, and they're like, well, what if we move some of that to Canada? Okay. Oil prices remain above 80, between 80 and 120. How about wheat prices? Do you guys think next year there's going to be a good year for wheat? What about right now? Wheat prices. Crops are being planted in the southern part of our planet, right? So when it comes time to harvest, will they have the staff? Will they have, how about even now? Do they have people to work the fields? Okay. Did you know this was discussed by Australia? Australia changed their immigration rules to allow, I think they said Pacific Island nations, whatever that means, to come into Australia without vaccination requirements, specifically to work on the farms. Cool, right? So if there's trouble getting those workers because they don't want to work in Australia because of Delta, or there's just a bottleneck, or they don't want to work at all, if there's a shortage of labor, there's going to be a shortage of food. What do you think food prices are going to be like next year, right? It's very interesting. One of the largest food exporters, if you want to look at it as a percentage of GDP, is Holland. It's amazing how much the Dutch produce and export. It's got to be one of the most productive countries in the world. They produce food. Okay. All right. With fertilizer and chemical prices up. Yeah. Lucas knows, right? Cool. Yeah. So fertilizer and chemical prices, but that's good for Canada. So one of the big businesses in Canada, the Canadians, so you got Canada. They go to places like it's slipping my mind. The little island, Trinidad. They go to this little island called Trinidad. Okay, and the major business there is nat gas exports. And they sell almost all of it to Canada. Now it's nasty nat gas. It's dirty nat gas. Okay? Which is actually a good thing. It's just not pure. So what Canada does is they buy it cheap from Trinidad because it's dirty nat gas. And they take it to Canada and then they crack it. Okay? Not frack, crack. So they take the nat gas and they break it apart. They crack it, break it apart. And one of the things they do with the stuff inside this gas, and like I said, it's dirty, so there's a lot of stuff mixed in with it. Okay? And one of the things they can make with this nat gas is fertilizer. Okay? And, propane and all that kind of stuff. But fertilizer comes from it, right? So in the modern world, fertilizer doesn't come from cow poop. Okay? It comes from Trinidad. And Canada then makes fertilizer and sells it to the Americans for big money. And the Canadians keep the profits. Trinidad stays poor. And Americans pay the penalty. Trinidad could just produce it fertilizer and sell it to Americans and get rich. But I'm not running to be president of Trinidad. But if I was, I'd probably do something like that. Cool. So anyways, like I said, thank you for being here. We're about 5 minutes away from non-farm payrolls. A few people asked my prediction. Why would you predict? Wait, you think if it's a big number, that's good? Or if it's a bad number, that's bad? But see, if it's a bad number, then there's absolutely no reason for the Fed to even remotely think about raising interest rates anytime soon, and that any little bit of inflation that we actually have now is definitely transitory because we don't have any wage growth, because you wouldn't have wage growth if we're struggling to add people to the workforce. So that's good news. Or if it's a red hot number, that's good news. No, it's not, because now people are getting hired, right? Therefore, there's likely soon, sometime soon, as the unemployment rate falls, wages will grow, and therefore the inflation that we see now is likely not to be transitory, because as I've shown you before, wages are not transitory, they're sticky. And therefore, the Fed will have to raise interest rates sometime soon, and that would be bad for the economy, because interest rates would be going up, yields would be going up, and oh my God, the stock market's going to crash, and people start freaking out. Oh my God, right? The piranhas are jumping into the canoe. What do we do? So bad numbers could be good, and good numbers are bad. Like, stop thinking so simply. Okay? Here's another piece of advice, not from me, from Jay Powell. So again, notice that I'm doing my research. Jay Powell slipped in one of his answers during Q&A, and he inadvertently mentioned the 3, the 6, and the 9-month average of non-farm payrolls. They're not even looking at this non-farm payroll number isolated. It could come out 720, it could come out 420, it could come out 220. And if you know anything about how they calculate these numbers, it's a crapshoot anyways. They're just throwing darts at a board and then revising after a month of additional research. So it could be almost anything, but more likely it's on trend. But I want you to think about that. The Fed is looking at, like, let's say the 6-month average. Last month, this month, last month, the month before, the month before, the month before, the month before, add them all up, divided by 6, and that's the non-farm payroll number. So another way of looking at it is this one-off NFP is almost pointless. So the fact that I'm sharing big fundamentals with you and a mindset of thinking and a mindset of work ethic and the mindset of research and planning is the value that you're getting. Nonetheless, the number's going to come out, the market's going to move, and it's going to move more based on what the market participants had been gambling on and whether they were right or wrong on that. Yeah, Matrix says he wanted to, maybe, but it didn't sound like that way. He didn't like, it was an answer. He was tired, by the way, because he started getting a bunch of challenges like, hey, do you feel bad about stealing money, about trading against the market when you were, so he got drawn down by that and he just kind of said it. But nonetheless, let's go over here. Let's look at the indices quickly. What we see there, dollar's been strong, but has given back a little bit now. Yen has been up and down. It's kind of weakening now in the moment. I have these on 15s now, so they're more sensitive than usual. Okay, pound is a dog with fleas. Somebody asked right at the beginning, am I going to buy that? I don't buy lower lows. I don't buy cheap. I don't buy cheap. There's no value in cheap. So how do I value something? I buy something going up that dips. That's not a dip, that's a drop. You can have it. It's all yours. Good riddance to it. Aussie, okay, same thing. It's cheap. I don't buy cheap. Euro, Kiwi, right? CAD is doing well today, so we want to look at that, but also we have CAD job numbers. So right now, I might kind of look at Kiwi. I might look at Euro. I might look at Kitty CAD, and I want yen to come down. I want dollar to come down, but we'll see. We'll see. Those are long-term points of view. but we're stuck in this kind of short term. So one of the things we could do is probably like do euro dollar, since everybody looks at euro dollar. Let's start with that. Or I can do this. I could just do pivots on this point. Okay. You know what? Yeah, I'll do it here so we can see. Pound, euro, Kiwi, Aussie, and kitty cat. I'm going to clean these up. Okay. I'm going to clean these up. Template, daily confluence, template, daily confluence, template, daily confluence, template, daily confluence, template, daily confluence. But I have to change this. Now I got to go to indicators, biased pivots, change it to bearish mode because it's USD kitty cat and all that kind of stuff. Cool. So we'll get with that. So we're just a minute now? Yeah, about a minute or so. Let me get back to the calendar here so we can get our results on the FX Street economic calendar. And once again, if you're just logging in, my name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, boutique foreign exchange trading firm. If you need a broker, TradersWay.com, try it, man. Try it. I'll show you. The swaps are huge. All right. Cool. Numbers coming out. No change in the participation. Average weekly hours are down. Interesting. 4.6, that's down. Cool. So 531, it's okay. That's probably a Goldilocks. It's not big, it's not small. Doesn't really change anything. It won't change anyone's opinion. Do you remember like those days when if it didn't matter what happened, if you like Trump, you're going to like Trump no matter what happens. And if you preferred Biden, no matter what happens, you would like him. It was kind of like that, where if you think that's bullish, you're still a bull. If you think it's bearish, you're still a bear. Okay. So it hasn't changed anything, which means a lot of people still think the Fed's going to raise interest rates soon. So anyways, so what you want to do is pay attention to these key lines. Now, some of these are still above and some, right? So for example, I'm really eyeballing this number and I'm eyeballing this number. Okay. For this one, I'm eyeballing down here, but remember, I'm not even interested in buying Pig Dog. Now you could sell it if you want, of course. And euro, I'm like, okay, maybe. So let's do it again. This is sort of a number I'm watching for that pair. This is a number I'm watching for that pair. I don't think we'll get down there today, but maybe. I'm watching this number, 70 on Kiwi, and I'm watching 73.5 on Aussie. And then kitty cat could go up and come down, so we'll deal with that later. Okay. Cool. My whole plan is probably Monday. Jimmy says the numbers are all cooked. Yeah, you know, the fuzzy logic to how they calculate it, you know, basically they call a couple of friends and they're like, do you got a job? And then from that, they extrapolate the entire country. You're like, really? That's what you do? You know, so whatever. I don't think it's manipulated. I just don't think it's incredibly accurate. Okay, cool. So at first, some dollar strength. At first, let's take a look at commodities, gold, oil, and Bitcoin, for example. Any response out of Biddy? Biddy, can't you see? Okay, all right. So we're stuck in this. Okay, not bullish, but we're above support, which is not bearish. So you're kind of, you know, as we kind of get in here, there's less room to move. So you have down, up, down, up, down. If support holds, you're going to get a range out of this. Then you're going to get a down and then maybe a breakout because it would be resuming, right? Be resuming. Okay. So it'd be like you got this on the short run, but you got that on the long run, right? Gotta run, right? So you could, I don't know how you want to look at this. So you're like, okay, right? Maybe there's this kind of thing going on now. If you're bullish on Bitcoin, if you're asking yourself, hey, are we going to go from 60 to 100? Yeah, probably, right? So it would probably do something like that. The other way of doing it, of course, is down here first. Okay. But based on analysis of seasonality, I would expect the dollar to weaken, and that in of itself might at least stabilize and support Bitcoin. And Bitcoin's going to do whatever Bitcoin wants to do, right? Cool. So that's interesting. So that no real response either, right? So if you go into here, no real response out of non-farm payrolls. Okay. So it's not as fundamentally driven as maybe a currency. Okay. When you take a look at oil, you should be analyzing OPEC plus. Okay. Currently, what's happened here is this top is held, made a lower low, lower high, lower low. And the interesting thing is, if you bought my book, you'll remember when I describe the old man easing into a hot bath. You guys remember that part of my book? I draw a chart, I swear to you, almost exactly like this. Almost exactly. The lower low, the big, right? The lower low, the big lower high, and then the drop. Cool. Yeah, Jens Oscar Mike. Yeah, that makes sense. Okay, so that's interesting. We'll have to follow that to see where that goes. What you want to do here is find where the support is, and it's way down here. You know, I don't know what you want to call it, 75, 76, 77, somewhere in there. And of course, if you're a trend trader or Elliott wave trader, you might want to, fib this sucker, and you'll see it's already marked, of course. But, there's a 382 if you're eyeballing that. Roll reversal, all that kind of stuff. So there's a lot of support starting at 78, and then the more psychological numbers more like 75. Cool, right? How about gold? Gold is priced in dollars. Gold. How we doing, gold? Well, here's the thing with gold, and this is just, I don't know, classic. If you're a bear on gold, this is the price you sell. Okay? For November. We knew that way out here in October. We knew it. So it's not like an opinion, right? We knew that if you were a bear, you'd be selling this. Okay? Doesn't mean down. It means that's where bears would sell. If there's enough bears, it means down. Also, back in October, we knew where the bulls would buy. Okay? This is the buying price for November. And we knew that way back here in October. Okay? Right there. Okay? So we knew a couple of weeks ago that if anyone wanted to buy gold, they would buy it here. Cool, right? So what do we know now? Not a lot, okay? But we might assume that those that bought down here are feeling really good, and then they bought it here on the roll reversal. And that should, let's say that could take out all the stops. So where are the stops? Where would you be if you sold here? Where would your stops be when you got down to this area in this zone? You'd move your stop, right? So I think there's a lot of stops right near break even, right? Sort of in here, which means if additional bulls bought here, what'll happen is out, and you'll get a big move up into that move, up into this resistance. Okay. Okay, and right now this upward move might just be bears exiting. And then that pushes it higher, which hits more stops, more bears exit. Because really, bulls are supposed to buy here. They might buy here, but this is where they're supposed to buy. So this could just be bears getting out on the news. Okay, and then stops will be hit, and that'll push it up to the next level, in which bears will have to make a new decision, sell there, and I don't think they will. This is not a selling price. It's resistance, but there's a difference. Right? Morning, Max. Okay. Cool. So anyways, there's gold. Now, typically though, gold struggles in November. So someone might actually be setting that up. Okay. But maybe this year's not a typical year, but we'll see. We'll see. You guys happy? Is everything good? How you doing, huh? Yeah, Maxie. Yeah, awesome. Cool. Cool. All right, let's take a look. Go back to the indices. Doing great. Right on. Yeah. So it's interesting. I also run an education service called FX Bootcamp. And I'd say 80% of the people here are members of FX Bootcamp. So come on. Where's the FXStreet people? Come on, FXStreet. Yen's coming down. Great. CAD going up. I didn't even look at the kitty CAD numbers. If anyone has the CAD numbers, please post it. Aussie turning bullish. Kiwi turning bullish. CAD turning bullish. Even the pig dog. Yeah. Coolio. So let's go look at our yens. And I don't expect entries, but as you can see, I do expect stabilization. Okay? So this is past work that's coming to fruition now. Okay? Oh, thank you, Manus. Okay. And this is I'm very interested in this price 84. I need a little more before I can buy it. I need to confirm the stabilization at 84. But right now, and wait for the joke, on the whole, it feels good. The other choice is way down there, and, well, that's not going to happen anytime soon, right? So let's add a little more time to this. And you can see I actually have it set up for next week as well. Or basically, next month. I'm going to change this to Confluence, but I just wanted to show that, I have it all set eyeball in that. Okay. Now I look here, and I have my monthly central. Great. I have next week's M2, which is great. This is a price in which I would look, not even expect, but look for a change in trend. So I would measure this as an M3, and I'd measure this as a CPP, and I'd say, okay, but I am a bull. I understand that this is where bears would sell. I understand that. Totally makes sense to me. We have a top, we have a top, we have a top. It makes sense. But now I would expect that these bears would leave if they're challenged. So I got to kind of measure this as a risk level. And I think that would be it. And now what I'm looking for is, up to the 4H21, down to the weekly M2, up to the future 55, down for a higher low, and then break. And I might buy it here and I might buy it here because I am fundamentally a bullish, right? I'm fundamentally a bull, but I understand bears here and I understand the move. I understand everything. Okay. My first opportunity is here. My second opportunity is there. And of course, if it breaches and we breach resistance, I'm on the free and clear plan to start buying all the dips and every dip, all and every dip. Okay. Lovely Tuliumum. Mana says 6.7 on the kitty cat for unemployment rate. Okay. Canada, okay, 6.7% unemployment rate. New Zealand, 3.4%. So, okay, by the way, I hope you feel like I'm dropping fundamental bombs on you. You're like, dang. Okay. Which, if you had to guess, which central bank raises interest rates first? Canada or New Zealand? These are unemployment rates. Salamapo. Because of the discussion we had here, 3% inflation, okay? 3% inflation is only transitory if there's no wage growth. And you cannot have wage growth if you have a lot of people unemployed. So it doesn't tell you when, but it helps explain why. So now you can look at things like unemployment rate. I mean, there's other issues like what do you count as the workforce and all that kind of stuff. But don't get into the philosophical questions. You'll never get a trade on if you're that philosophical. There's a headline number. What's the headline number? Is it bad? Is it good? Is it improving? Is it getting worse? So you want to look at the direction and the rate of change. And then you have to ask yourself, how does that impact wages? And then if wages go up, how does that impact long-term versus short-term inflation, household wealth effect, asset prices, consumption on GDP, okay, which all leads to business investment, right? So on and so forth. So yeah, New Zealand first, but not now. Okay? But not now. Because they have great employment, or let's say unemployment statistics, but they don't have the wage growth. Australia's in the same boat. They're not even close to the needed wage growth. Not even close. It will be years, according to the RBA, when they decide to raise interest rates. Yet, many, many, many people on TV and in the newspapers are betting that Australia is going to raise interest rates. And even the head of the RBA scratches his head and he says, I have no idea why they think that. So do your own work, guys. Don't listen to me. Don't listen to the talking heads. Don't listen to the experts. Don't listen to a guru. Do your own research. And you'll find it's pleasantly clear. This is not, you don't have to say, oh, well, Wayne, I don't have an economics degree from Harvard like you do, so I don't understand all this stuff. A lot of it is understandable. Okay? Okay? A lot of it is understandable. And what you don't know, write it down and say, what does it mean, the debt service level requirement, right? Yeah, property is out of control, but they specifically talked about the regulatory requirements that have changed at the banks and also the managerial focus at the banks to deal with high prices of real estate relative to household income levels. So one of the things the RBNZ has talked about specifically, like 2 days ago, guys, I'm not talking about weeks ago, months ago. They talked about it just 2 days ago. And they said there's two ways of looking at the real estate market in New Zealand. Okay. And they say, one, there's the debt service ratio. Okay. And there's the loan to value ratio. Okay. Okay. And this has to do with how much money you have to put down, your down payment, right, to receive a mortgage, but also relative to when you get a mortgage, when you sign a contract to buy a house, you already have your mortgage lined up, but it's only like you're sort of pre-approved. But then they have to go out and they have to send an appraiser to value the house, to say, what's the house actually worth? You might have negotiated $1 million, but it might only be worth $900,000. So if the appraisal comes back and it's 900K, comes back and it's 900K, and you negotiated $1 million and you were going to put 200,000 down, okay, it might change things. Okay. The other thing, right? So they may or may not, but they're looking at the value of the home, and you have to put down certain amount of money. Okay. Okay. Loan value. The house has to be worth a certain amount. The other side is you have to have income to support the mortgage. So I don't know what a mortgage on a $100,000 house is, but let's say it's $1 million. Okay. $1 million house right now will cost you $5,000 a month in a mortgage payment. Okay. Not 500K, sorry. Just 5,000. Okay. So they want to say, can you afford to service this debt? What kind of job do you have? What kind of income do you have? How steady is the income? Like, do you have 6 months worth of employment history at your current job, or 30 years? Okay. But anyway, so my point here is, John is right? These property values are going up, but New Zealand understands this. The banking system understands this. The regulatory compliance rules and the managerial rules of each individual bank are addressing it, and they are looking at it from both views of that value of the house, but your ability to service the debt. And if you lose your job and you can't service the debt, at least they can dump the house and get you out of your mortgage, and you'll probably still be profitable, but you'll lose your house. Okay? So my point is, it's being addressed. If it's understood, it's much less of a risk than if it's not understood. They're on it, man. I'm telling you, it's basically the only thing they talked about. There was a little bit of like supply chain issues due to COVID and some inflation. They talked a lot about, in the speech, about the stability of banks. Well capitalized. They went through their Basel III stress tests. Everything came out fine. And then the rest was real estate, 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 real estate. So they're on it, man. They're on it. They got it, man. They got it. Okay. And the Reserve Bank of New Zealand, they're not just a bunch of cowboys, right? They're like conservative, thoughtful economists and business people, right? Yeah. So they're on it. They're doing their job, and they're doing their job well, in my humble opinion. Okay. So if they're on it, it's much less of a risk. Cool. So anyways, good questions, y'all. Good questions. So that's what you need to nitpick through. So think of it this way. If you were going to invest $1 billion, but you had to choose which country you want to build the factory, right? You look at these things, right? Anyways. And other people are making those same decisions. Okay, so we'll look at Kiwi here. Okay, Kiwi's on the way down. Let me reset this. Daily confluence bullish. Okay. And look, we have 2155 down. We have everything below the 200. I'm not trading this right now as a bull. Remember, my long-term view is bullish. Long-term. Like until March 31st. On April 1st, I'll no longer be bullish, but whatever. So I'm just defining long-term. So I look at this, I'm a long-term bull, but I recognize over the last two weeks, basically, it's not bullish. Cool. Right on. Cool. Cool. Fine. Great. Great. Fine. Good. Max, did you miss the whole hour before the news came out? I think you did. Come on, man. You have to rewind. I discussed that in great detail, man. Come on, man. Come on, Maxie. Yeah. No, it's all right, man. But I'm just saying, I spent 25 minutes talking about that. All right. Like somewhere along the line, even up here, so this is one standard deviation above the mean. This is one standard deviation below the mean, and this is the mean. So the first thing is we kind of have to bounce off of this support, get back to the mean, and then find a higher level of support, which we call a higher low. And then we need to make the higher high. And then we make the higher low, which is another opportunity. So this could be a buy here on Monday. This could be a buy here on Tuesday. But the thing is, we're not on any sort of free and clear plan until we get above that. And where will the bears sell next week? Does anyone know where all the sell orders are? Would anybody like to know where all the sell orders are? Yeah? Okay. Push the thumbs up button above 150. This is for FXStreet. Thank you, FXStreet, for hosting me for 187 months on this one webinar. Thank you, FXStreet. And when I see that go above 150, then I'll let you know where I believe all the sell orders are. But just as a common courtesy, right? I mean, it should be over 200. Thank you for the thumbs down, for me asking you politely on behalf of our host, and then clicking thumbs down. What an amazing person, huh? Whoever did that, I think your mother is disappointed in you. All right. Thank you. I appreciate everything you did. Thank you. And thank you to FX Street for hosting me for, almost 20 years. Cool. Thank you for that. Okay. So the first thing I want to do is clean my palette and look at this from a long-term bearish point of view. You ready for this? Okay. So the selling prices this month is that price, which occurred on the first day. So as I said, whether it was this pair or a different pair, I fully understand what they did and why they did it. It makes sense to me. Now, I might think they're wrong, but that makes sense. Okay, and the next one is there. So we'll look at that because we're still above it. So, it's not really applicable. Oops. Okay, so I'll delete that. Now, let's change this. So I'll go to my indicators list and I go to my biased pivots. I'm going to change this from monthly to weekly now and look at this week's sell zone. So what we knew several days ago was that this is going to be the sell price for this week. You see the accuracy? Now remember, a seller has to have the price go above to cover the spread and then it sells. That's why there's one wick above, because price actually had to go above to enter all the sell orders. So there was billions and billions of dollars worth of sell orders right here, but we knew that days before it happened. So if you don't know that, you don't know where the bears are. You don't know the selling. So let me repeat. Back in October, we knew bears would sell there. And then last week, let's say on Friday, so 1 week ago, we knew that this would be the best selling price for this week. And we also know this is the best selling price for next week. Look at that. That's Monday's sell price, $81.50. It's not that it will sell, but if you were going to sell, and if bears are going to continue selling, somewhere between 81.10 currently and 81.50 basically, right? It's actually, 43 or something, but okay. So we'll look at that. So I'm going to add another line here and say, well, that's the best price. Now I'm going to throw in a weekly, the aggressive price, and we'll put that there. Okay, cool. So now let's drill in even further and see if we have any confluence. So I'll go back to my indicators. I'll open up my bias pivots and I'll say daily now. So we've done monthly, then weekly, and now daily. Okay, cool. So you can see this sell zone is also the next week's central pivot point. So there's a confluence there. So I'm going to mark that. Okay. And then I'm going to mark this. You know what that is? You know what that is? 80.82. Monday's selling price. Monday. I did that before this, Max. That's why I had the sloping down, sloping up. Then I said, look, I need a double bottom, higher high, higher low, and breach resistance and have it pull back and buy it. So I just did that, Max. Come on, Maxie. Okay, cool. So, right? So we're looking at that. If this downtrend continues, basically, okay, what we see here is that's an aggressive move, and this is a more realistic move for Monday. Oh my God, it's Friday morning, and I already have a trade plan for Monday. Now, here's the thing. I'm not a bear. I'm a bull. So I have to see what the bears are going to do, and I expect the bears to do it. It makes sense to me. I think they're going to do it until it stops working, right? So how do you make it so bears stop trading? Well, you need a reversal pattern. Okay? So I'm going to sit around and I'm going to wait for a reversal pattern, which means the bulls and bears are going to fight it out without me, and that the bears are going to lose and the bulls are going to win. And that means I need an up, a down, an up, a down, and so on and so forth. Oh my God, I just drew that just a few minutes ago using a different technique completely. It doesn't matter the technique, it matters what you do. Okay, is this a higher low? I'm a bull. Okay, so let me tell you what I'm going to do. I'm either going to buy at support, and I'll define that in a second because most people define it wrong. And two, I buy higher lows. Do you understand? There is nothing else. If you're losing money or you're finding inconsistent results, it's because, number one, you don't know if you're a bull or a bear. And then two, if you know you're a bull or if you know if you're a bear, you don't follow the basic, right, universal truths of trading. You understand that? You're not even following the basic universal truths of trading. You can ask somebody that's never traded before, never even looked at a chart, but they know you buy low and sell high, but you don't buy low on the way down. Do you know who buys low on the way down and then justifies it as dollar cost averaging? Right? A broke-ass trader. Okay? So we go back to this. I'm a bull. Am I going to buy this? No. You can have it. It's yours. Go ahead. I hope you do because I want this to go up. Okay? But what if you said, well, I got a support line here. So what? That's not support until you have a double bottom. The most basic confirmation of support is a double bottom, right? You can't have a one-touch support. That's not support. That's a guess. That's a bet. I bet you anything it'll stop falling. You know what? It'll fall forever. Do you know how you catch a falling knife? You don't. Do you know how you stop a runaway freight train? You don't. Okay. So that's where all the bears live. There's limit orders. They're waiting. They're ambushing. Okay. But I'll tell you what, technical analysis confirms or denies market conditions. Like if you're a bull, does this confirm or deny bullish market conditions? If you're a bull, does this confirm or deny bullish market conditions? Right on, traveler. My goal in the next couple of years, I want to teach economics and finance at Harvard at summer school. So I can take a break during the quiet months of trading and teach. I love teaching. Yeah, this denies. This denies. This is down. I'm a bull. Okay? So I need to buy a higher low. So what's a higher low? Well, right now, this is, okay, support. This is resistance. This is a lower low. It's a lower low. How many lower lows can you have in an uptrend? None. Denied, not bullish, walk away. Don't turn your back in anger, but just walk away. Just walk. You're like, oh, it's not bullish. Pass. Oh, but Wayne, I have to trade every day. Dude, seriously? A little emotional. Okay. So anyways, lower low predicts the lower high, which predicts a lower low, which predicts a lower high, which predicts a lower low, which predicts a lower high, which predicts a lower low, which, you understand? So now my job is, I'm still a bull. I get it. I see what they're doing. I understand. That's an MM3. I get it. That's what I would do if I was a bear, but I'm a bull. So what do I need to do now? What is my job? To confirm or deny market conditions are favorable for my money, but I know where my money is going to go. I had to sit down and talk with a client months ago to tell them what I was going to do. If you can't do that, you're not going to be able to raise money. Let me tell you what I'm going to do March of 2022. Oh, you don't know? Then you're not going to be able to sit down and have a logical conversation with a sophisticated investor. Because you're like, I don't know, every day I have no idea what I'm doing. It just doesn't work. So I'm a bull. I'm patient and disciplined. So what's my job now? Well, I saw the lower low, so that predicts a lower high. Got the lower high, makes sense to me. So that predicts a lower low. Look, it made a lower low. That makes sense to me. So that predicts a lower high. Well, if you get a lower high, that predicts a lower low. That makes sense to me. And it will continue that for absolutely forever without me buying it. Seasonality, long-term fundamentals, Jove. Okay. But I could. I'm not there yet. But Jove, you're right. You make a valid point. But I'm not there yet. Okay. Also, okay. So now what? What I'm looking for is when this model, it's only a model, breaks. Because then it confirms the market conditions that I want to trade in. Okay? So imagine there's three market conditions, Jove. Bullish, bearish, and pigs. Okay? You're either a bull, a bear, or a pig. You know what bulls do? You know what bears do, but what happens to pigs? Oh, I've trained you so well. You guys are awesome. I love it, man. Thank you. Right on. That's awesome, huh? Cool. So yeah, pigs get slaughtered, which is, this is up, this is down, this is sideways. Okay. So what I'm looking for is analyzing when I can execute trades as a bull. And bulls buy uptrends. Okay? So let me do all this, get rid of that, get rid of all of this. Okay? So one of the things I'm looking for now, because imagine, this is what I was trying to get to. Imagine now as a bull, let's say I only buy higher lows. Think of that. I skip every double bottom, triple bottom, quad bottoms, penta bottoms, deca bottoms. I don't buy its support. Okay? I also don't buy lower lows. So I get rid of lower lows, don't buy them. Double bottoms, triple bottoms, whatever bottoms. I don't buy bottoms. What if, as a bull, I only buy higher lows? Will I be profitable at the end of the year? Jove says only on the 4H. No, you can do 1H. That's fine. The 1H, higher lows kicking off of a 21. That'll put your kids through college. Well, Traveler, it is I know what you're saying. He says it's not about the amount of trades you take, but I'm not saying take a small amount of trades because that's bad advice. That means there's a lot of luck involved, and therefore, if it's luck, it's a form of gambling. I don't want you to get lucky in your trades, but I do want you to be consistent. So if somebody looked at your trading history, they would see, 1, you're profitable. 2, you're consistent. You're like, dude, you spent the whole year and all you did was buy Kiwi yen? You're like, yeah. In certain market conditions, I bought Kiwi yen. And 3, right, you have low volatility. Okay? Which means not all of them are going to be profitable, but most of them, because you're only buying in a trend. You understand that? You're only buying in an uptrend, and you're only buying low in an uptrend. You're only buying low in an uptrend. So therefore, the only way for you to lose money is the uptrend reversed, which takes you out. But by definition of a trend, there's multiple higher lows and only one lower low. You understand? So like, let's say 5 out of 5 trades, 4 are winners, 1's a loser. It might be 8 trades and 1's a loser. It might be 12 trades and 1's a loser, depending on the trend and the seasonality, right? But you understand that? Now, I want you to think about then what happens next. You have, let me erase this again. Just like a professor, right? Just like a professor. Let me erase this from the chalkboard. So let's take this idea and move it forward. What does this do? Okay, you have your return, because you would be profitable. Someone would understand what you're doing. They'd actually look at your trade history and go, oh, I see what you're doing, which is very important when you're talking with clients. But return over low vol. Well, return over volatility. What is this called? What ratio is that? That's the Sharpe ratio. Okay. When you sit down with a sophisticated investor, you know what they're going to look at this first thing. If your potential investor looks at your return first, they don't know what they're doing. And they don't have any money either. Because someone sitting down looking at a Sharpe ratio first means they're already invested in other things. They might have some real estate. They might have another Forex guy. They got some equity people. There's an options trader. They got some Bitcoin. They got some Doge. They got some Shiba Inu, right? They got Ethereum. It's all working out, but they're like, so let's compare what you're doing versus all these other things. You versus apartment buildings. You versus Bitcoin, you versus a bond portfolio, like you versus all these other things, apples to oranges to bananas. So which one do you do? They all have different levels of risk. They all have different levels of leverage. They all have different levels of return. Which one is the best? So if you got no money, you don't know any of this because you're not in anything and you're just guessing. You're like, this guy used to make money. Well, yeah, as soon as the market conditions change, he won't make money. A Sharpe ratio says, okay, how much money was returned But how much up and down was there while you were getting it? The higher the volatility, the lower the Sharpe ratio. Because what it's saying is, if one month you're up 100%, and the next one you're down 50%, and the next one you're up 100%, like it's all over the place, the only way you can guess on your year-end return in the future is like, well, what particular day do you happen to measure? Because it might significantly change your results. That's volatility. And if a potential investor can't figure out how much money you will probably make them at the end of the year, then it's stupid. And you try to figure out through all kinds of ways, but the Sharpe ratio will say there is a return. Oh yeah, there's an absolute return, because you're not going to invest into someone losing money, right? So the Sharpe ratio will say, okay, this investment vehicle has produced a return, but not enough to compensate you for the risk. So now you can compare multiple Forex people and throw in an equities guy, an options gal, right? A bond strategy, a real estate strategy, a crypto strategy, private debt strategy, merger arbitrage strategy, and compare them all. And what this tells you is for every unit, okay, for every unit of risk, how much dollar do you make? So for every dollar of reward, okay, that you make over how much for $1 of risk, how much dollar reward? Okay. So what I'm trying to teach you is very often you see something like this. Someone comes in and says, I got 95% winners. I'm a great trader. I almost have no losers. Then you do a Sharpe ratio on them and they're 0.72. What does that tell you? Their winners are small, their losers are big, they have a return, but it's inconsistent and unlikely to bear fruit for the amount of risk you're taking. That tells you to pass. High winning results sucks. Now the next guy comes along and you have a Sharpe ratio of 1. What does that mean? Well, they took risk and you were compensated for the risk appropriately. Risk is equal to reward. It's neutral. They did all right. It's all good. What a professional investor is looking for is like 1.8. So for every 1 unit of risk, the reward exceeded the risk significantly. Okay? So the only way to do that is reasonable absolute return over a small level of volatility. And this is the type of trading I preach. I do not preach get rich quick. I don't preach go, 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 trade, 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 sell, 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 buy, buy, buy. If you want to be a professional investor, you want to look at this. You want to look at what you produce with the lowest reasonable return over lowest volatility, and someone will come along and look at your returns and they will say, oh, you're profitable. Oh, I totally understand what you're doing. And you have low volatility, so your Sharpe ratio is excellent. What's your minimum? Huh? Does anybody like this way of thinking? That's where you get the facts, man. FXBootcamp.com. And here's the sales pitch. You can join my live group if you sign up at FXBootcamp.com. That's it. Done. The first thing is it'll ask you to put in money. It's not a lot of money, but it's a commitment. You have to make the jump. Most people don't have money, so they're not going to do it. It's hundreds of dollars, not thousands of dollars. The next thing is you need to put in enough time. Most people don't put in enough time. They don't have it. They're unwilling or incapable. So the first two objections is, Wayne, I don't have any money. Well, good luck. Get a job, work your ass off, save. The second thing is, Wayne, I got money, but I don't have time. Well, consider Forex as a second job, work nights and weekends. I went to Harvard for 5 years in my 40s, and you tell me you can't work nights and weekends, be a reasonable husband and raise children and have a career? Dude, I ain't Superman, but I did it, and not for a little while, 5 years. I lived on the Harvard campus every frickin' summer, year after year after year. You can do this. Come on. But if you can't, it ain't going to happen. So you got time and money, and then what? You better have a ridiculous, sickening work ethic. Monster, crazy, hard work. Blood, sweat, and tears, and willing to do it for years. If you don't have that, it ain't going to happen. Forget it. Quit. Might as well just quit. What's the point? Richard, I've never said anything like that. And it's not even close to that. Not even close. You're not even in the ballpark. Yeah. Yeah, I don't have like an education empire. You know, that's not what I'm actually interested in. Yeah, there's not thousands. I don't have 20,000 members. I don't have 2,000 members. I don't have 1,000 members. You're not even close, dude. I don't spend time building it. This is what I do. I help people. If you want to join, join. If not, good luck to you. You'll probably find a way. It might just take a lot longer. Yeah. No, I don't have a massive empire. So I'm on a couple of mailing lists for gurus because I've known these gurus from, speaking at conferences and stuff. And these guys send out 2 or 3 emails a week. Sign up for this, sign up for that. Here's my free gift. Come to this thing. I'm doing a webinar. This is my friend. He's going to show you his awesome strategy. This guy's making $1 million. You should come watch this. I'm like, oh my God, 2, 3, 4 freaking emails a day. Dude, I don't send you an email ever. I don't pitch you stuff. I don't have any new way of making money. If you watch my first Non-Farm Payrolls 187 months ago, it's exactly the same. I don't have anything new or cool or a pitch or... dude, if you want it, want it. Okay, anyways, let's move on. Okay, let's take a look at the indices again. Yen flipping, dollar flipping, all over the place. Kitty cat doing well. Euro being anti-dollar, that makes sense to me. But again, Kiwi, Aussie strengthening, and pound, I'm still not even interested. So Aussie, Kiwi, and CAD are my 3 biggest ones, and those are the 3 I've been trading, I think, mostly through October. Okay? Mostly through October. Thank you, Thiago. How about this? Let me give you one more sales pitch because I do want you to join. Let me give you a sales pitch. How many people here are FX Bootcamp members and made more than 1,000 pips in October? Did anyone, as an FX Bootcamp member, make more than 1,000 pips in October? And we're prepared. I'll even throw in there. We're prepared weeks in advance to be ready. There's my sales pitch. Weeks and weeks and weeks in advance. We're ready, willing, able, ready, nailed it, made it, done. Like, there you go. So if you can't do that, you don't know how to trade. Cool. Thank you, guys. That and shows you the loyalty and respect. So thank you, everybody. I appreciate it. Maybe we'll have 1 or 2 new members, and that'd be cool. All right. So yen, I'm walking away. Dollar, I prefer dollar and yen going in the same direction. So this yen strength here. So anyways, let's take a look at dollar pairs, and I'm interested in commodity currencies. How do you join? FXBootcamp.com. It's got an internet, World Wide Web site. Darko said even I made it. Yeah. Cool. And the interesting thing about it is I called the bottom 6 months in advance and the top 6 months ago. It's crazy. Huh? Crazy. Do I do private lessons? I do from time to time, and it's quite expensive. Yes. I haven't in a long time because I was in grad school. Yeah, it's a different gig. Like I might mentor one person, let's say in the first quarter of next year, just because it's fun. I mean, I don't have a lot of time, but it's a different gig than mentoring basically a group of people. It's a little different, right? Typically it's 10 grand and up depending on what you need. Okay. But I've said no to dozens of people, but I'm interested again. But again, I haven't sent an email or told anybody. So anyways, it might be a good like side project in the first quarter. All right, cool. So let's go through dollar pairs. Yeah, dollar. Okay, I look at this, and what do I see? Support. Eddie, you would email me, Wayne at FXBootcamp.com. Okay, cool. All right. Okay. So I got support. Can I trade this as a bull? Actually, you can. You can trade support. Okay? Notice can doesn't mean should, but you can. Yeah, sort of like maybe is a great answer. Yeah. Like if you took a shot there and lost money, I wouldn't yell at you. I would understand. Okay? But now what you should do is drill into a smaller time frame and confirm your right, okay? The right side of the equation here. And so what I'd want to see on this area is what? Confirmation of the support. Respect of the support. One touch is not good enough. But what if you now got up to the 21, down to Monday's M3, and then support there? What if you were buying on Monday's M3 and basically this moving average had just dropped about to where price is? Well, now you have a double bottom of a double bottom. It's still aggressive, but can you do it? Do you have permission to engage? Yes. Because on a 15-minute chart, you would have a 5-8 cross up. You would be above the 21 EMA. So it would look more like that. But anyways, so you could on a 15, you'd cut this corner, and your target on Monday now would be 135.50. Then you're taking that even farther north. Okay, cool. Probably 137 or 138 next week if you're a bull and it turns bullish. Cool. You got to break it down. Now remember, you have to ask yourself, is this bearish? Well, what stands out most to you? Well, what stands out most to me is this. The market wasn't behaving that negatively at that moment, right? Okay. Okay. And that is not bears. This is bulls realizing that they've made a mistake. And they're getting out. So the question is, do they get back in at a lower price? Now, I think a lot of retail traders are going to try to sell this. And this actually probably, listen to this, probably will go lower. This probably won't work. It's not what the charts say. That's why I said, could you buy it? Yes. Should you buy it? No. Because I can tell you, this right here tells me this down here is the target. That's what it says. I'm not making an opinion. If you're a bear and this is the top, this is the projected bottom. So, dude, seriously, this could do this next week, and the trend is almost certainly going to continue until it stops. Okay? So, like, to take subjectivity out of it, let's measure this statistically. Y is equal to mx plus b. M is equal to slope. And slope is equal to rise over run. In this case, M is less than 0. Therefore, this trend statistically measuring from all these data sets, the data set is this time frame, all the closing prices in that data set, and that says bearish. And you want to come in and buy it. Why? Why? What's your problem? What's your problem? Why do you have to buy it? What's wrong with you? What's wrong with you? There's something seriously wrong with you, right? That's Ghostbusters, by the way. Hey, man, you gotta have some pulp culture, right? Yeah, that's Ghostbusters. Peter Vaker, Dr. Peter Vaker, or whatever is Vakeman. Anyways, what I would rather see over the next period of time, let's say the next day or two or three, is more of something like this, that we can then measure the slope, rise over run this way, and the one standard deviation below the mean, one standard deviation above the mean, and therefore we now have uptrend. Trend, where M is greater than 0. Rise, okay, rise, run, rise, run, rise, run, rise, rise, overrun. Cool, right? Reddick says, hey, I'm only you've only been a member of FX Bootcamp for 1 month in the day trading group. And it's just awesome. After years, I am not blind and I can see trades and reasons why what happened. Nobody else taught me this great view. Awesome. Appreciate you sharing. That's really cool, man. Rocking and rolling. Okay. Cool. So that's pound. Now, maybe fundamentally something's changed, but what this tells me, what the Bank of England said, fundamentally, fundies, not changed. That's what the Bank of England said. Nothing's changed. It's just a bunch of bozos bought it because they expected us to jack up interest rates, but we never said we would do that, nor did we even discuss doing it. So those guys are a bunch of bozos. Unfortunately, you probably read it in the Wall Street Journal, the Financial Times, Barron's Magazine, Investor Business Daily. You probably saw it in Bloomberg. You probably saw it on Fox Business. You probably saw it on CNBC. And you're like, oh, I guess the Bank of England's raising interest rates, but shame on you. You didn't do your job. You relied on a journalist major. A journalist major who writes good. I write good. They don't know anything about economics and finance. And you're relying on those guys to make your billion-dollar decisions? Okay? They said the economic data is close. Right? Marvinus? They said the economic data is close, but they didn't, it wasn't a serious consideration. And that they tried to kind of warn the market. And Bloomberg pushed on them because obviously Bloomberg misreported it. And they pushed on them like, dude, why did you say all this stuff that made us think you were going to raise interest rates and then not do it? Aren't you hurting the market? And he pushed right back. He's like, you guys are the ones that published it. I never said I was going to do it. I said the data is close, but it's dependent. And we're not there yet. And he's like, so don't you push on me. So here's the short story to all this. Do your own work. Don't rely on a journalist major that makes $27,000 a year to make your billion-dollar decisions. Okay? Cool. Kiwi. Now, I like Kiwi. I'd like to be a buyer of a Kiwi. I bought the heck out of Kiwi back in October. Okay. But now what? No, I got out about the middle of October. I tried a couple of times here and there. I got snapped on this one. I got snapped on that one. But, you know, my winners are bigger than my losers, and everything's fine, man. So now I have to do I buy it again? Well, what I declared, I don't know, a week and a half ago, I'm interested at 71 and I'm interested at 70. So maybe. Okay. So should I buy this at 71? I got my price. What's up, Russ? Hey, I said this a week ago. I want to buy it at 71. Why not, Manus? I said that's the price I'm interested in. Does anyone else want to take a guess? Yeah, it's a lower low. I don't buy lower lows. I buy at support. It's not support until you double bottom. That's just a lower low. If you buy it now, you're guessing. You're betting. You're a degenerate gambler. Oh, I bought it off the central pivot point and the weekly S2. Yeah, I get it. I get it. You bought at, at supportive levels. You bought at a good price. Okay, I get it. It's a good price, but it's the wrong time. Notice that the only thing we have to measure, ladies and germs, the only thing we have to measure is over here is price. Down here is time. So if you bought that, you bought it at a decent price, but at the wrong time, it might work. But under the probabilities right now, it probably won't work. You will probably lose money. But you might make money. But if you have inconsistent results, it's because you do stuff like that. Oh, I bought it at support. Oh, really? Yeah. Well, good luck to you. It might work. Maybe it won't. Okay. But I buy uptrends. So in my day trading course and in my swing trading course, I start the videos this way. Hello, my name is Wayne McDonell and I'm a trend trader. And I like to buy higher lows. Okay. Cool. Okay. Cool. If you're a bear, then do what bears need to do. Let me set this up from a bearish point of view. You ready? Indicators, biased pivots, change this to bearish mode. I have it on bullish mode. Change it to bearish mode. Figure out what would a bear do. I'm going to put a day trading bearish bias. Okay. Check this out. You ready? Monday's selling is right here. The swing trading group meets every Thursday. That's correct. The day trading group, which you can't join unless you're a member of the swing trading group, that meets every day. Yeah. Yeah, swing trading is once a week. Day trading is daily. Okay. So if you're a bear, okay, you're in your sell zone. Now notice this. Notice the reaction of selling here, selling here, selling here. Why? Because that's Monday's sell zone. Wait, you're not trading Monday right now? You're still on Friday? You don't know how to trade. you're behind the 8 ball, man. You don't get it. You're missing a giant piece of information. What's happening now is based on tomorrow. I never trade today. I planned today, yesterday, or a week ago. So if you're rolling into non-farm payrolls and you're like, hey, what's up, fellas? What do we got? Are we buying or selling? Dude, you will lose all your money, either quickly or slowly. Okay? This is all about Monday, and you should already know that. Look at that. Okay, cool. Huh? Look at the accuracy. Oh my God, Becky. Yeah, huh? Look at that. Don't turn your back on me. Look at it. Nice, right? Cool. So you got to have the right tools and you got to have the right knowledge, and maybe, just maybe, you'll survive. I don't know. Looking at Aussie, right? As I mentioned earlier at the beginning of today's presentation, that Governor Lowe will not raise interest rates for years and years and years and years. And, you know, so people are starting to learn that. Cool. Ooh, oh, I'm huge on seasonality. Okay, let me show you this. Kiwi dollar. I think I just did it. Yeah, I just did it. Okay, Kiwi dollar. Seasonality. Look at this from a monthly point of view. So I'm going to do position trading, bullish bias. Okay. This is the bullish buy zone. And I said I was interested and I want to buy it, right? Why? Over the last 5 years, okay, by the way, this green zone was established weeks ago. We were talking about it up here. So it's not like now it just drew because we're there. No. We already knew that price a week ago, 2 weeks ago. Okay. Based on November, every November in the last 5 years, COVID, pre-COVID, when you add all that up and you look at whether New Zealand dollar closed higher or lower at the end of November. So you have the beginning of November on that day. Okay. Did November close higher or lower on average? And if so, if it was higher, how much did it appreciate? The answer to this, would you guys like an answer? If you know, because I already told you, don't tell anybody. How many people would like an answer to that? I'd like to see the thumbs up go over 200 thumbs up, which means we need some new people to click the thumbs up. Huh? Can we get over 200? By the way, 3 people have said this webinar sucked. Whale oil B. Well, thanks for showing up and participating anyways. Thank you, Manus. Come on, we're at 199. Come on, Bubba. 201. Thank you, new people. Thank you, new people. All right. Cool. Let me tell you. The answer is plus 2%. Whoop. Okay, so the answer is, over the last 5 years, Kiwi dollar, pre-COVID, post-COVID, typically closes higher at the end of November than when it opened at the beginning of November, and on average appreciated 2%, which means if it just dropped 1% in value, that if from this buy zone, we might be able to expect a 3% because we got to get back to break even and then appreciate. Woo! Yeah, boy! And some people trade and they have no idea what they're doing. Wouldn't that just be horrible? God dang it. That would be terrible. Now, we don't know if that's what's going to happen, but we're taking a model. And it said, well, that has happened over a recent period of time, and maybe it can happen. Again, we don't know. Maybe this year's different because we're tapering and all that kind of stuff. Great, because we didn't taper last year or the year before or the year before or the year before or the year before. So maybe it's different. But we can incorporate that into our biasy and say, well, typically I like to buy Kiwi dollar in November. Great. If you were to buy, so if you asked me a week ago, right? If you were a buyer a week ago and you said, Wayne, help me identify a decent price to buy New Zealand dollar versus United States dollar. And I'm like, well, we're at 72, but I think 71 or 70 are better. There's more value. And that's an okay setup because when you asked me, we are at a higher high. What does the higher high predict? A higher low. Somewhere between 71 and 70. Right? So now we're at 71. Can I buy it? Not yet. Because I don't know if it's 71 or 70. So I'm not a degenerate gambler. I need to confirm market conditions are favorable for buying, and then I only buy low, not lower lows, higher lows, because if the trend is up, so put it this way, it's sort of a food for thought here. If the trend is up, okay, then we have appreciation, right? The asset based on the trend will appreciate in value over time, correct? And then I only buy dips. What is buying dip doing in an uptrend? Why not just buy high? Because I'm accumulating value. Okay? Buying low in a downtrend, you're not buying value. You're not buying value at all. You're buying something that is worth less. Literally, think of it. If it's worth less, it's worthless. I don't buy worthless stuff except my Shiba Inu. It's the only thing I ever bought that was worthless. Only because my son and I were having Dogecoin conversations over lunch. I'm like, okay, fine. I'll buy something worthless as a basis of conversation. But other than that, I'm not in the business of buying stuff that's worthless. I buy value. I want to leave you with one last thought over the weekend. I'm going to introduce you to a professional investor. Oh, I don't know. Let's call him Alistair because he's English. Alistair, darling. Not just Alistair. And Alistair is from the UK. And he went to some university in Bristol. I don't know anything about Bristol. And he has an economics degree, which means he couldn't get into business school. So he had to so he got an economics degree instead. So, I think he's a regular dude. I don't think this guy was born with a silver spoon in his mouth. I don't think he's upper class. He didn't go to Oxford or Cambridge or even London School of Economics. I don't know. He went to University of Bristol. He's just an average dude. And as an average dude, somehow he got into finance. Okay, cool. And he worked for a hedge fund. And the hedge fund did all right. So then he gets a job. Let's make up a company. Let's call it BlackRock. It's very specific, right? So he works at this place called BlackRock, which runs his hedge fund. And it's ranked versus all the other hedge funds in the world. He's in the top 100, but not near the top of the top 100. Oh, is that right, Darko? I don't know anything about Bristol. I don't even know if it's in the country, on the sea. I have no idea. He's in the top 100, but at the bottom top 100. Okay? So it's pretty, like, he does his job. He's profitable. He's not the best. He's not upper class, all this kind of stuff. He's just a regular dude doing a decent job. And in January, he lost 2%. And in February, he lost 0.5%. And in March, he made 1%. And in April, he made 7%. And in May, he lost 1%. And so on and so forth. And then all the way to October, in which he lost money. And when you add it all up, because there was another 7 in there, when you add it all up, Alistair makes 2% per month over long periods of time. But he also has long periods of time which, he hasn't found his trend. There hasn't been a trend. He lost some money. Then he lost some more money. By the time he got to January, February, and March, so he started the second quarter at break even. He didn't even make money until April. He got back to break even in April. Then he had a good May, and then gave some back in June, and then had a great July, and then summer doldrums. And do you understand? Can you achieve this, guys? Can you do at least something like that, where you have some pretty decent good months and no real bad months? Do you have enough patience to not freak out if you've gone 3 weeks without a decent setup? 3 weeks over the course of a year is nothing. This guy even went 12 weeks without really catching a trend, and then the trend kicked in and he's doing well. Then he was blindsided a little bit by some of these central banks. Hey, happens. Now, I had a great October. He lost money, whatever. But can you guys envisioning achieving something of this stature? You're a regular dude. Your performance is reasonable. It matches the market, which we call beta. You don't take on too much risk. But here's the thing, 2% a month. 2% a month is 400% return in 10 years. Do you understand that? You might be saying, that's stupid, 2% is nothing. Dude, it's 400% return over a course of 10 years. You forgot about that part, right? You're like, oh, wait, what? That's 25% a year, compounding. Oh my God, that's actually good. Yeah, 8% is yeah, I get that. 8% is great. But also he has more money than you, and so it gets more complicated. Okay? Also, he's not a Forex trader, but it doesn't matter because everyone's just going to look at Sharpe ratio, and maybe they invest, maybe they don't. Okay, let me leave you with one last thought. Doing this, okay, if you know, don't answer. But how much did Alistair make? How much did Alistair get paid, not make? So he works for BlackRock. BlackRock keeps most of the profit. And then they pay their employees a pittance. So it's not like he's collecting the whole 20% for himself. He gets paid a pittance of that. Okay? So after the profits collected for the clients, 20% goes to BlackRock. And then after BlackRock has their 20%, they pay all the expenses. And then after all the expenses were paid, they throw a couple of bones to Alistair to keep him happy. So what did Alistair earn after all of that, personally, in his bank account, paid on corporate check? Huh? Drum roll, please. Okay, answer if you know. That way, I want it to be believable. How many people know? And if so, go ahead and answer. Alistair was paid $90 million for the year as the portfolio manager, getting a nice little bonus at the end of the year for doing his damn job. $90 million. Oh my God. 90 million. And you're thinking, wait, what? I can do that. Aha. Maybe, maybe not. What value did Alistair provide? Month after month, quarter after quarter, year after year, Alistair produced moderate returns consistently with low volatility. And over a long period of time, through all kinds of changing market conditions, he provided this service of reasonable returns with low volatility. And at the end of the 10 years, the money had compounded by 400%. So for those that are trying to get rich quick, you're on the wrong path. Okay? You're on the wrong path. If you're trying to get rich quick, you're on the wrong path. This is about long-term views, long-term goals, steady, consistent returns over long periods of time with low volatility. Return over volatility. And Forex Noob said that is a huge fund if that's a small part of 20%. It's true. It is a big fund. But that's not the point. See, the assets under management changes how much you earn, but you still need to do the very basic service. Consistent returns with low volatility. That's why it's consistent. Returns over volatility. People don't want big returns. People want consistency. And I want you to focus now. The analogy here is street basketball versus college basketball. Yes, you could be talented, but there are two different types of games to be played. If you're still trading like an amateur, trying to make a lot of money quick with big lot sizes and skippy scalpy, you're in and out in 12 minutes and this, that, and the other thing, that's one way to make money, but that's street ball. That you're not being groomed for the professional game. And the professional game is quite different. And what you want to see is what Alistair's producing. Consistent, low volatility returns over long periods of time. And now, when Alistair goes out to pitch a potential client, he walks in and he doesn't say, oh, I lost 2% in January, but hey, by April, I was back to zero. And then I had a great July. No, he walks in and says, my fund is up 400%. And by the way, look how low my volatility is. And they're like, where do I sign up? What's your minimum? And then he says, well, how much do you got? And they say, well, we have 100 million. Nope. My minimum is 250 million. I got to go. It's the weekend. I got a Cohiba waiting. Thank you at FX Street. Thank you to the moderator. And thank you to you for all your great questions and your inquisitiveness and that you're here to the very end. Please visit tradersway.com. Open up a demo account. Give Traders Way an opportunity to earn your loyalty and respect. They'll pay you bigger swaps than your current broker, almost for sure. But also fast execution speed and stuff. And look, if you don't know how to trade and you want to learn how to trade, you need to join FXBootcamp.com. That's it. Look, boom. Hardcore understanding. I'm not going to teach you a little trick or my particular technique. I don't have a particular technique. I teach understanding so that you can make your own informed decision-making process. And by that, you will be able to plan your trades in advance. And from that, you'll probably have more consistency with less volatility. But dude, I'm not the world's greatest trader. But if you want to try, I will help you. Peace on earth. May the pips be with you. May your profits be above average. And I hope you join FX Bootcamp, and I'll see you Monday. Cheers.